Welcome back to The Explainer. I am so thrilled you're hanging out with us today because, well, we're going to unlock the secrets of analyzing a business's financial health. Look, if you've ever stared at a company's financial reports and felt like you were trying to read some ancient, undecipherable language, you are definitely not alone. It happens to the best of us. Today, we're going to translate all that jargon into a clear, compelling story using the power of structured visual analysis. So, it's the ultimate question, right? You look at an annual report, and it's literally just walls of numbers. It can be incredibly intimidating. But there is a cheat code to cut through all of that noise and get straight to the heart of how a business is actually performing. That cheat code? It's called financial ratio analysis. It's basically the ultimate tool for comparing different businesses across entirely different industries, or just evaluating a single business over time.
Okay, let's dive into this. Here is our visual roadmap for today. We'll start with Section 1, the Ratio Analysis Foundation. And then we're going to move right through profitability, liquidity, efficiency, leverage, and finally, price ratios. Let's get right into it.
Section 1, the Ratio Analysis Foundation. Before we jump into all those specific categories, we really need to ground ourselves in what a financial ratio actually is. I know it sounds complex, but fundamentally, it's actually very simple.
A ratio just tells us how much of one thing we have compared to another thing. Think of it like a personal household budget, right? You're comparing your monthly rent directly against your monthly income. In our case, we're simply comparing the size of one line item in a financial statement against another line item. To do this, we primarily use two playing fields, the income statement and the balance sheet. You can think of the income statement like a video. It summarizes revenues and expenses over a whole period of time, like a full year. The balance sheet, on the other hand, well, that's a photograph. It's a snapshot of a business's assets, liabilities, and equity at one specific point in time. Now, here's a crucial pro tip to remember. When you create a ratio that compares a line from the video against a line from the snapshot, you always want to average the opening and closing balance sheet numbers. That just makes sure you're actually comparing apples to apples.
So how do we actually categorize all these comparisons? We use 5 main ratio groups: profitability, liquidity, efficiency, leverage, and price. Now look, I want to reassure you right now, please do not worry about memorizing every single mathematical formula we are about to discuss. Seriously, that is not the goal here. The goal is just to understand what each of these categories is actually telling us about the business's fundamental story.
Oh, and one super quick logistical note before we move into that first pillar. Because most of these financial ratios are expressed as percentages, you are almost always going to multiply your final calculated result by 100. It's a simple trick, but honestly, it just makes the data so much easier for our human brains to interpret at a glance.
All right, Section 2, profitability, generating the gains. This group of metrics is entirely focused on measuring how efficiently a business transforms its raw inputs, things like its revenue, its assets, its equity, into actual bottom-line financial gain.
If a business is a machine, this measures exactly how much value that machine spits out. Profitability ratios split really nicely into two camps: margin ratios and return ratios. Margin ratios live purely inside the income statement. They measure how well a business converts its top-line revenue into profit, whether that's gross profit, operating profit, or net profit at the very bottom. Return ratios, however, are a bit more cross-functional. They take that bottom-line net profit from the income statement and compare it back to the balance sheet. This lets us see exactly how much profit was generated relative to the assets or the owner's equity used to create it. Think of a lemonade stand, okay? Your margin is how much profit you make on each cup, while your return is how much profit you made compared to the total cost of building the stand itself.
But, there's a potential trap when looking at return on equity. Some businesses will actually inflate their return on equity by taking out massive, long-term loans to fund operations. This reduces the owner's claim on net assets and artificially spikes the ratio. The solution to this little trap is a metric called capital employed. What's really interesting about this is that by subtracting current liabilities from total assets and just ignoring long-term debt entirely, we get a much clearer, unmanipulated picture of how well a business uses its core capital to generate returns.
Let's move to our next section and see how this builds. Section 3, liquidity, surviving short-term debt. While profitability looks at the grand strategy of making money, liquidity strips all of that away to ask a much more urgent, existential question: can this company actually survive to see tomorrow?
Literally, can it pay its immediate bills?
Evaluating liquidity really just comes down to a straightforward comparison. You look at the current liabilities. These are the short-term debts that a business absolutely must pay within the next 12 months. Then you divide your assets by those liabilities. If you only look at pure cash, well, that's your cash ratio. If you include things like accounts receivable, that becomes your quick ratio. And if you include all current assets like inventory, that's your current ratio. The golden rule here? If that resulting number is bigger than 1, the business has enough liquid assets to cover its short-term debts. Easy enough, right?
Okay, Section 4, Efficiency, the cash conversion machine. Once we know a business can survive the short term, we obviously want to know how well it runs on a daily basis. This section shifts our focus entirely to operational speed. We are looking at how effective a business is at moving inventory off its warehouse shelves and how quickly it collects the cash it's owed from customers. We measure this speed using turnover ratios. These include inventory turnover, which tracks how fast goods are actually sold, receivables turnover, tracking how fast you get paid, asset turnover, and payables turnover, which is how fast you pay your own bills. Fundamentally, these ratios compare an income statement activity against a balance sheet asset. Why? To tell us exactly how many times a business repeats its core operational cycles over a given period. Usually, higher turnover means a faster, much more efficient machine. But we can actually flip those turnover ratios upside down to calculate something even more intuitive, the cash conversion cycle. This vividly illustrates the exact timeline of a business. It's like a giant puzzle. We add the average days it takes to sell inventory, plus the average days it takes to collect cash from customers, and then we subtract the days it takes the business to pay its own suppliers. The final number there tells us the exact number of days it takes for a business to turn its upfront investments in inventory back into cold, hard cash in the bank.
Moving right along to Section 5, Leverage, Managing Debt Risk. Now we really have to talk about risk. Leverage is essentially what happens when a company decides to up its risk profile by taking on third-party debt.
The goal, obviously, is to maximize their potential rewards and fuel expansion. But borrowing money comes with the very real risk of recurring interest payments. We analyze this risk from two entirely different angles. Over on the balance sheet side, we have ratios like debt to assets and debt to equity. These measure the total volume of debt being used to finance the business. But on the income statement side, we have the interest coverage ratio. Now, this ratio doesn't care about the total volume of debt. It just checks to see if the business's operating profit is actually large enough to comfortably cover the recurring interest payments on that debt.
To get the absolute truest picture of debt serviceability, analysts often use a term you might have heard thrown around before, EBITDA. It stands for earnings before interest, tax, depreciation, and amortization. Basically, think of it as the raw cash a business generates from its day-to-day operations, before the tax man or the bank takes their cut. By excluding non-cash expenses like depreciation, EBITDA reveals the true cash profit a business actually generates. We then divide that EBITDA by the total debt service to see if the company truly has enough cash flowing in to cover both its interest and its principal loan repayments.
And that brings us to Section 6, Price Ratios Valuing the Investment. So the crucial point here is that up to this point, everything we've looked at has been an internal metric.
But how does that translate to the real world? This is where we finally bridge the gap between the internal accounting of the business and the external, constantly fluctuating world of the stock market. Investors rely heavily on earnings-based price ratios to evaluate if a share price is actually worth buying. Earnings per share, or EPS, tells us exactly how much profit is allocated to a single share of stock. The PE ratio takes the current market share price and divides it by that EPS. It tells you exactly how much the market is currently willing to pay for every single dollar that the company earns. And then the PEG ratio takes that a step further by factoring in the company's expected growth rate, which gives you a much better idea of its true long-term value.
We also have dividend-based ratios. Instead of just looking at theoretical profit allocations, these look at actual cash payouts. Dividends per share and dividend yield are absolutely essential metrics for a certain class of investors, mostly because they represent the literal, tangible cash income that is distributed directly out of the business and straight back into the shareholders' pockets. But as we wrap up our visual journey through financial statements today, I really want to leave you with this thought. We've seen how metrics like the PEG ratio rely entirely on expected EPS growth. And expected growth is just that, right? An estimate, a projection, a guess. Which really begs the question, when you're using these ratios to invest your hard-earned money, at what exact point does the hard math end and human market psychology begin? It's a fascinating limit to the data, and something every single investor has to grapple with.
Thank you so much for joining me on this explainer, and I'll catch you in the next one.